Hey now, this Forex member says his system is highly discretionary. What happens when we remove all subjectivity? This is Trader's Landing. In this installment of Trader's Landing, we are going to examine the Williams %R SAR Crossover 15-minute candle system, including the indicators used and entry criteria with examples. Then I'm going to test it 100 times in a row, followed by an analysis of the test data, a review of the equity curve, and conclude with my thoughts on the strategy. You can review the system specifics in the video description along with the link to the thread on Forex Factory where I found this strategy. Just a note before we begin, I asked the question on this thread if anybody has done any backtesting, and this was the response from the thread creator, Rocky Point. This system is highly discretionary, so any backtesting I would think needs to be done manually, a very large task. You seem to be looking for a black box system with strict rules, which you could develop, I guess, but using this just going by indicators is a loser. Day trading requires good understanding of price action and being ruthless with money management, risk management. These are infinitely more important than indicators. Also why I don't think you can make a successful EA. That being said, on this channel, I review rigid indicator-based trading systems with strict and clearly defined rules that you follow each and every time you see it on the chart, no matter what. So we have 2 points of view on this particular topic. Let me know your thoughts in the comments. Now let's get into it. The indicators we use in this system is going to be the Williams %R, which is a built-in indicator in TradingView. I'm going to just change the color to yellow, change the upper band to 50. And make it a nice bright white so we could see it. Remove the middle band, the lower band, and the background. And press OK. We're going to use the Parabolic SAR Strategy indicator, which is another built-in TradingView indicator, and that's going to be default settings. And I'm going to add the 200 EMA just for trend direction. So for a long example, we're looking for the Williams percentage to be over the 50 line, price to be above the 200 EMA, and for a Parabolic SAR entry signal, which all happens on this candle right here. That's our trigger candle. Going to place our buy there, stop below the swing low, and we're going to target 2 to 1. And that is a winner. So here we have another entry. We have price above the 200 EMA, Williams percentage above the 50 line, and we have a Parabolic SAR Strategy buy signal. So that is our trigger candle. We are going to buy right there, place our stop below the swing low greater than 5 pips, and target 2 to 1. And that happens right here. So we have another winner. We have a short entry available to us here, price below the 200 EMA, Parabolic SAR Strategy indicating a sell, and the Williams percentage under the 50 line. So this is our trigger candle. Place a stop above the last swing high and target 2 to 1. And that actually brings us to a profit on this candle right here. So we have a setup right here. We have price under the 200 EMA, Parabolic SAR Strategy, sell signal, and the Williams percentage under the 50 line. So this is our trigger candle, stop above the previous swing high, targeting 2 to 1. And let's see how this plays out. And we are a winner. So now it's time to do what we do. Let's review the test data. This test was done on the Euro USD on the 15-minute candles. It took 4 months to find 100 trades. There were 45 winners and 55 losers for a winning percentage of 45%. Most consecutive wins in a row was 5. Most consecutive losses in a row was 4. Gain on the account was 35%, risking 1% per trade. The equity curve here is interesting. You can see it starts out very choppy, ranging up and then down. This is where most traders would have just moved on to a new system. But if you stuck with it, you clearly see a nice uptrend. How do we find the crumbs on this system? Just by eyeballing it, a multiple take profit exit strategy may not be that effective here, but maybe adding a trend continuation method like hidden divergence could work. One may be tempted to look at the beginning of the equity curve and see what filters you can add, but you do not want to pigeonhole a system based on a very finite set of data. You could always come up with a system that works on one set of historical data, but without extensive testing, there is no way of knowing what to expect on another data set. In conclusion, we have 2 valid schools of thought here that are common in this industry. This system was profitable on this data set, so it could be worth optimizing further and then go through some additional testing. Thank you for watching. Please hit the like button, subscribe, and turn on notifications. Let me know if you have any questions, comments, or concerns in the comment section below. Bye for now.